If you're planning to buy a home and you're not in a position to pay cash, can we agree that understanding your financing options is pretty darn important? In this video, I'll walk you through how pre-approval actually works, why it's so important in the Portland Metro and Southwest Washington markets, and how to choose the right lender without getting tripped up by confusing quotes. This is step 2 of the home buying process. In step 1, I explained why hiring the right realtor comes first and how that decision makes the rest of the home buying process so much easier. Hi, I'm Brandon King. I'm a licensed real estate broker in Oregon and Washington. I'm also a licensed mortgage broker. Hopefully this will help me explain the lending side clearly without the usual confusion. Before we go any further, let me say this clearly. You can use any lender you like. If you already have a lender you trust and want to work with, great. If you want me to be your realtor and also your lender, my team and I at Mortgage Trust can help with the pre-approval and the mortgage. If you'd like to separate the lending from the real estate representation, but don't know who to call, I can recommend multiple excellent local lenders that I'm not affiliated with. My role is to help you understand your options, not make you feel pressured. In this market, getting pre-approved really isn't optional, so let's talk about why it matters so much. First, pre-approval establishes your real budget. You probably already have a guess at what you can afford. This might be based on how much debt you can stomach or a payment you're comfortable with. It's great to know these numbers, but once a lender actually reviews your credit, income, debts, and the down payment you've saved, that number often changes, and sometimes by a lot. Pre-approval replaces guessing with clarity. It gives you a real home price range and a realistic monthly payment. Here's a quick myth versus reality. Here's the myth. Pre-qualification is enough. The reality, sellers want a full pre-approval, and so should you. A pre-qualification is usually based on unverified information. A pre-approval means documents have been reviewed and the lender is confident the loan will be approved. Second, pre-approval protects your time and prevents a lot of unnecessary disappointment. I would hate for you to fall in love with a home you don't qualify for. This frustration is completely avoidable by getting pre-approved first, so we can keep your search focused on the homes you can confidently afford. Third, pre-approval makes your offer worth considering. In many Portland Metro and Southwest Washington neighborhoods, well-priced homes sell quickly and sometimes even receive multiple offers. Sellers want to be confident you can close the sale. A strong pre-approval letter helps give them that confidence. So why not get pre-approved? It costs nothing, and there's no commitment to work with that lender should you change your mind. It's also pretty quick. You can probably fill out the application on your lunch break. Did you know your lender can help influence if a seller chooses your offer? This is something most buyers never hear. When listing agents review offers with their sellers, they're not only looking at price, they're looking at risk. If a seller's agent sees a local lender they recognize and have had a good experience with, one who closes on time and communicates well, that can absolutely influence which offer feels safest to accept. I've seen sellers choose offers with a slightly lower price simply because they trusted the lender involved. I've also seen offers rejected because of a lender the agent had a bad experience with. A recognizable local lender can reduce perceived risk. An unknown or unresponsive lender can raise concerns and keep your offer from getting accepted. Who you choose for financing matters. Most people don't know this, but there are actually 3 different types of mortgage lenders. First, there's mortgage brokers. This is what we are at my company, Mortgage Trust. Brokers shop multiple wholesale lenders, often providing more loan options, more flexibility, and different underwriting approaches. This can be especially helpful if you don't have time to shop around for the best rates, or if your situation is anything other than very straightforward. Typically, mortgage brokers can provide the lowest rate and closing cost. Next, there's mortgage bankers. They fund their own loans with a pool of investor money and offer a fixed menu of loan products. They often have strong local branding, but have fewer options to offer you. Then there are the depository lenders. Think banks and credit unions. These can sound easy and appealing if you already bank there, but they're often slower and more conservative with their lending decisions. In competitive markets, response time matters. And real estate often happens outside of bankers' hours. There's no single best lender for everyone. The right lender communicates clearly, identifies issues early, and can perform under pressure when timelines matter. And one more important point, Just like your realtor, a good lender should not be someone you talk to once and never hear from again. A strong lender becomes a long-term financial consultant. They track your loan over time, they watch interest rates, and they reach out when refinancing could lower your payment, shorten your term, or help you leverage equity strategically. For many buyers, this is how real estate becomes a long-term wealth-building tool. Refinancing at the right time, using equity to purchase additional property, or restructuring debt thoughtfully can make a big difference over the years. The right lender supports you well beyond closing day. Now let's go a bit deeper into the most common loan programs. Keep in mind that guidelines change over time, but I'll share with you what they are at the moment. First, conventional loans. Your credit scores need to be at least 620, but interest rates do improve with higher credit scores. Down payments can actually be as low as 3% for qualified buyers, but usually at 5% it makes the most sense. Loan limits can vary by county, but in the Portland Metro, they are currently a little over $830,000 for a single-family home. One advantage of a conventional loan is that if you put at least 20% down, your lender won't require private mortgage insurance. If you're putting less down, mortgage insurance can be removed once you get to a 20% equity position. Next, FHA loans. Minimum credit scores can be as low as 500 with a larger down payment, and with scores of 580 or higher, as little down as 3.5%. These loans are more flexible for buyers with lower credit scores or higher debt to income ratios, but they include mortgage insurance for the full loan term. Then we have VA loans. There are no official minimum credit scores, though most lenders look for scores around 620 or higher. No down payment is required and no monthly mortgage insurance, so this is a powerful option for eligible veterans and active duty service members. We also have USDA loans. There's also no down payment required, but there are income limits and the home must be in an eligible rural area. The property eligibility map can be found at usda.gov and are usually in outlying communities. There are also jumbo loans for buyers who need to borrow over the conventional loan limits and renovation loans for homes that need work. There are also a ton of options for investors, flippers, and landlords. I realize this is a lot of information and you definitely don't need to memorize it. Just know that there are options for almost every buyer. One question I get asked a lot is, how do you compare confusing rate quotes? Here's the trap most buyers fall into. Everyone wants the lowest interest rate, but often the quotes you're trying to compare aren't apples to apples. One lender may show you a lower rate, but charge you a higher closing cost to get you there. Another may show you a slightly higher rate with a lower fee up front. Both quotes can be accurate, but which one is best? When comparing lenders, you have to look at both the interest rate and the total cost to obtain that rate. Think about it like a balance scale or a teeter-totter, with the interest rate on one side and the closing costs on the other. Higher closing costs on one side makes the interest rate come down on the other. On the other hand, less money up front for closing costs makes the rate go up. When both the closing costs and the interest rate are taken into account, you have the total cost of the loan. If one quote looks dramatically better, it's usually because the fees are structured differently behind the scenes. So what do lenders actually evaluate before giving you a pre-approval? First, they look at your credit report to understand how you've managed debt in the past. Next, they review your income to confirm your ability to make the monthly payment and still pay your other bills. They confirm your assets are enough for the down payment, closing costs, and reserves. They verify employment to confirm stability and consistency. This isn't about being perfect. It's about being clear. Most challenges can be addressed once they're identified, but only if they're discovered early. Here are the documents you'll need to get your pre-approval started. Luckily, these are pretty straightforward for most buyers. Typically, you'll be asked for recent pay stubs, W-2s, or 2 years of tax returns if you own your own business or are self-employed. You'll also need 2 months of bank statements and photo identification. If you can provide these up front, it helps avoid delays later and allows your lender to give you accurate information instead of guesstimates. Once you're pre-approved, your lender will send you and your realtor a formal pre-approval letter. This is your green light to shop confidently and move quickly when the right home comes along. So how did I do? If you're feeling informed and confident, that's the goal. If you're feeling like all of this is as clear as mud, welcome to Mortgages. You're not alone. In part 3, I'll talk about how much money you actually need to buy a home. I'll dispel some down payment myths that hold buyers back and why trying to save 20% for your down payment can can be a huge mistake. If you want to start your pre-approval now, click on the link in the description to get started on the application. And if this was helpful, please like and subscribe. If you didn't watch the first video in this series, go back and check it out. Step 1 is just as important.